out and fresh shorts trying to pound the market that usually put it in these bottoms, and that's what increases the volume. So the market does not have enough, there's nobody left to buy on the break, so the shorts have nobody to sell to, and that's what tends to turn the market higher, because the shorts start to cover their positions, and that puts in that bottom. So this starts, though, with the first bottom. And so normally you're going to see heavy volume into the left shoulder, and also you can get heavy bottom volume into the head, but typically it's less than the shoulder, and that tips you off from a volume standpoint that this is a potential accumulative pattern, accumulation pattern, because you're getting a divergence. You're getting a market that's going down in terms of price, but you get volume that is sometimes less than the previous low. Those are all real good indicators, especially those divergences between price and volume. As a side note, this week in the gold market, when the gold made its final top for the week, that was done with a volume divergence, an open interest divergence in the futures. You didn't see the same amount of long traders with conviction at the top as you did the day before when the market was approaching the top. So in this particular pattern, you want to look at volume characteristics, and you want to see if there's any kind of divergence. So a divergence, again, would be price going lower than the previous low, but volume coming in at less than the previous volume level. So that's one sign that volume and selling pressure is shrinking. Now the right shoulder is definitely formed on lower volume than the head and the previous shoulder. And this is because sellers aren't going to be fooled anymore. New shorts aren't going to come in and try to press this market because they got burned at this point on this retracement, and they got burned on this point. So they're going to be less aggressive here. And this gives the buyers a chance to take over, and as I said before, to start accumulating on this support point, and they start to defend this support level and prevent this market from going down to that new high. To people that follow conventional analysis or Gann analysis, this is known as a secondary higher bottom. And a secondary higher bottom is usually the safest area to start looking for a change in trend, because unlike again, the non-professional, I want to say, or the novice trader, most professionals look for what we call a lean, and a lean is our exit. So we tend to look for their exit first rather than the entry. And if you scan the internet and read books and things, you hear a lot about trading systems and where you can get in and where the market should go to. But the most important part about trading is knowing where to get out ahead of time when you're wrong. So once you have a bottom put in here, like this head, and you see this rally up here, when the market starts to come down into this old support area, that's the point, this old shoulder, that's the point where you should start looking for a potential bottom, because this is your lean, this is your out. In other words, you're saying to yourself, I know I'm going to get out if it breaks this head. So if I get an opportunity here to start looking for a buy, and it could be a reversal on a candlestick, something that tips you off that the market's going to move higher. Or auto chartists can give you a signal and an emerging pattern to give you a tip that this market may be getting ready to turn. So once the professional knows that he's got a lean in the market, maybe there's size down there, maybe in a stock there's 100,000 on the bid, something that's helping him out, he will try to get long in this particular area here, knowing that he can exit underneath here. And that's what forms, that's what happens when a secondary higher bottom is formed. And then, again, you get this bigger stick here. You can see the size increase, and that's usually the last of the shorts bailing out and the fresh longs finally recognizing and committing to the long side. And that combination of short covering and fresh buying drives that market higher through the resistance zone through the resistance line identified by AutoChartist and giving us the breakout signal. So that's the mechanics of the inverse head and shoulders pattern. Just some more little notes and tidbits about the head and shoulders pattern. It's a bullish reversal pattern. And it's a reversal because you've had this long, prolonged declining move. Again, I look in terms of price and time, and so you're getting a price and time break, which is sizable. And now you're getting a reversal. So it is a bullish reversal pattern. Now, AutoChartist is going to, when this pattern shows up, it tends to pick it up as it shows you a downtrend taking place, because that's how the initial trend began. But by the time it becomes completed, you can see that it changes it to reversal here. See that trend change identifies it as reversal. So that's real important to know. And as I said in the beginning, the head and shoulders and the inverse head and shoulders are two patterns that AutoChartist identifies that we pretty much know or can count on the direction. In other words, head and shoulders for tops, inverse head and shoulders for bottoms. They may not always work out that way, but if you have a bias to the upside, or if you see a market that's been down for a while forming a support base, then definitely you want to start looking at inverse head and shoulders patterns, because they are the one major indicator of bottoms. Okay, another way to look at this pattern is that it finishes a downtrending move and starts a new uptrending move. Okay, maybe later when I go through some other patterns, we'll see what happens when this market comes down. You'll see that the downtrend ends and then the uptrend begins. One key that you want to always look at as a trader is, and it's an ultimate goal of traders, is at first you're happy about taking one side of the market, the short side, maybe down to a bottom and getting out, or maybe the long side and getting out near the top. But as you progress as a trader and you put pressure on yourself to improve, you're going to want to try to catch a down move and an up move at the same time. So this pattern here can help you identify these transition zones, and your trading stats will improve, and you'll be a lot happier about trading when you can catch both sides of the market, a down move to an up move back to a down move. So that's just a personal preference or a goal that you should have as a trader, to be able to figure out where you can be in the market all the time, capturing up and down swings. And AutoChartist will help you with these patterns and look for those kind of scenarios. Okay, remember that the left side, again, the shoulder and the head were created by down moves. Okay, then you have this retracement here, and again, it fails to go through the previous neckline or previous top, and that is again a sign that buying isn't strong enough to break out. People aren't willing to buy strength yet at that level, and there's work to be done. But when you start to see this bottom forming here, and you start to see one test of that support area start to hold, and then you see a second test. Now, I'm thinking now that you're short the market and you're trying to squeeze out as much as you can, and you start to see a third and a fourth test of that market, it's giving you enough signs that it's getting ready to turn. Okay, so if you start to see these signs, you have to start thinking about taking some kind of action. So the right shoulder here is really the first warning sign for short traders that this downtrend is coming to an end. So it's important that when you are trading one side of the market, maybe you won't want to use this as an entry to the long side, but you can also use it as an exit to your short. Always remember that on these breakout patterns, that you can look at them two ways. If you're a born bearish trader, or somebody that has this lean towards the downside, who likes to trade just shorts, shorting the market, then you can also use this as a trailing stop for your position. So if you're short the market, you see that AutoChartist has identified a head and shoulder, an inverse head and shoulders pattern, then by all means you could start trailing your stop up above here, and then let the market stop you out for a valid reason, instead of just taking a guess where you should get out. So this pattern is good for both traders, those who like to trade the short side and are looking for a stop, and those who want to trade the long side looking for a potential breakout and the start of a new trend. Okay, now we have one more question. This question is, true or false, an inverse head and shoulders chart pattern is a bullish reversal pattern? Let's see if we can get more than 58% voted. I'm from Chicago, so we say vote early, vote often. I don't know if this allows you to vote twice, though. Okay, we've got 88% true. That's pretty good. It's down a little bit from that first question, but so far everybody's passing. And at the end, when you're asked if you liked me and my presentation, make sure you vote more than once. It's always good. Okay, now another thing you want to look at here when you're discussing this head and shoulders chart pattern is that some demand begins to come in at the formation of the head. Okay, you can see from these candlesticks that we had these spikes that could be indicative of demand coming in. So the market's ending up above the previous neckline, or previous shoulder line, excuse me, and all the activity is taking place up here. The body of the candlestick's taking place up here. That could be indicative of demand coming in. And you also want to know that greater demand creates a higher low, and that forms the right bottom. Again, a cluster here, these four candlesticks, that also is indicative of demand coming in. And if you have the opportunity to look at order flow, which I think everybody does now for equities, for example, you should be able to, you may be able to identify a big buyer in the market coming in. And again, it's those institutions that are trying to disguise as much as they can their buying interest, because what happens is if they come in with a big order, you're going to get this, and then they have to chase it. They'd rather try to buy it inside here when they can still get it cheap, and then try to be in ahead of this breakout. All right, and again, this is the last warning sign here, this accumulation on this right shoulder, that if you're short, you better start thinking about covering. Now, one other thing that you want to look at with this particular pattern is you may want to use with another program in conjunction with this pattern is volatility indicator. And as we all know, volatility expands and contracts. It expands and contracts. So basically what you're trying to do during this pattern where you have range bound, you see this pattern and you see a tight and narrow range, it's indicative of something that could take place in the future. So you want to, yes.
Sorry, we lost signal there for quite some time, a few seconds. What? I'm not sure if it happened to everybody, but can you maybe just repeat what you said the last minute or so, because we lost you. The signal was very bad.
Oh, sorry about that.
Thank you.
Okay,
No,
I've been informed that we lost the signal here for a little bit, and I believe it was right around the time I talked about volatility. What I was saying is that when you have a pattern form like this that shows basically a sideways or a range-bound market, you want to see that take place on low volatility. You want that volatility low because volatility moves from expansion to contraction, expansion to contraction. Now with volatility, you don't know which direction it's going to indicate, but since we have a bias to the upside with this particular pattern, when you're looking at low volatility combined with a pattern that has a tendency to indicate bottoms, then that gives you confidence that this market is likely to break out to the upside. So you want to look at any pattern that compresses, whether it's a triangle pattern or this head and shoulders pattern. You want to see if you can get this range as narrow as possible, or if you're using an outside program in conjunction with AutoChartist, you want to see if you can get something that is at a historical low or maybe a implied low, say a 20-day low volatility or a 5-day low volatility, depending on the indicator you use. If you can get low volatility combined with this particular pattern, then it's basically